Hello guys, in this video I will try to speak about 8 criteria to consider when you are investing in stocks. It means these criteria, some of them are different from what you read or from what you see online, because it needs from you to do some research. Okay, it's not easy. It's not just you go to a website and they give you stocks, or they give you companies like this and they give you some reasons and say, okay, buy these companies, and that's it. You should understand what you are doing, because in the future, if you do a mistake, you know that you did a mistake because you have your own criteria and you see them. But if you follow other people and they give you just companies, understand that when you are investing, like Warren Buffett says, that when you invest, you should think about 20 years or more. This is what we call investing. It means you are putting money to the test for a long time because you believe in the companies that you are investing in. You believe in them. Okay? But if you are mistaken, sometimes, let's say you invest in a company, but after a few years, it's not that good. So when you see that, you can change that according to the criteria. Now, anyone or each one has his own criteria. For me, I have 8 criteria to consider. So we will go through them, and maybe sometimes you get astonished that you don't find what the other people are saying or what you find in books. Sometimes it is not true. Let's say, for example, PE, which is one of the criteria that a lot of people they use. But understand that from a sector to another sector, you find that this PE, okay, it is not a valid criteria. So we are not speaking about what in general you find in books or you find in some people that they just follow. They don't understand anything, they just follow. When you follow people without understanding, this is the real problem. So let's go and check one after the other, and I give you the reasons why you do so. And later, if you want to do the same, or you add your own criteria, it's not a problem, but you understand really why I choose this company and I don't use that company. I will give you an example. Few years ago, I shop in one company, retailer, okay? But I see it's a good business, okay? It's clean. A lot of people, they come to this store. I see a lot of people buy a lot. And when I go to its price, I see it's going up. So I decided to make an investment in the company. It means to buy shares. I will not tell you how many shares I bought. And I don't talk a lot about investment or investing, because what I do for a living is swing trading. But investing, it is something for a long term. So when you see the chart, it doesn't look that much good. But I bought it, like, when I discovered it, $85. Now it's nearly, I think it's nearly 170 or 180. Okay? Now this, and by my surprise, I go to Warren Buffett list of stocks that he has, and I find the stock, my company, I find it that he chooses it. So I understand that Warren Buffett when he choose that company. I don't know when he choose this. I can search for it, but I don't care that much, because what I discover is by myself. And then when I go to Warren Buffett, I find that he owns this company. It means he owns some part of this company. Now you are inquiring, what's this company? I'm not saying you begin to think that it is Apple or something. No, it's not. It is Costco. Costco is a retailer, and it has a membership, and it is like Sam's. It's the competitor of Sam's. So why I choose it, I will explain in this video. So please be patient, because when I want to explain something, I will give details for those who are interested. And then when you get my criteria, you can add your own criteria, or you can delete one of the criteria. It's your choice, because you know, investing is something for the long run, for many years. And my objective is just to clarify things that a lot of people, they don't talk. You don't find it. There are some criteria that they say you will never find it online, or when they find it, they go through it very quick. They don't explain why. Okay, so let's go and begin with the first. The first thing is we say the 5 criteria. The first thing I changed is it's not 5, but it is 8 criteria. Okay, now 8 criteria. We can begin with the first. Okay, so be careful. Okay, now let's see what is this dividend increase. And you say to me, why do you think dividend increase is a good criteria when you buy a company? Now look at this. Let's say a company, in the dividend, it's giving in each quarter, it means in each 3 months, it gives 0.25%. 25%. This is the yield. The yield. Okay. So 0.25% is in the quarter. They give this for each share. Okay, for each share you bought, you will get 0.25%. Now, what does it mean? Dividend increase. This dividend, it is, let's say, in 2017. Now, this year is 2018. How much is the dividend? Okay, let's say it is 0.35. Now, the company, when it is good, it tries to give more dividend each year, because the company decides for how much dividend it will give, and it is free. It means the company can stop. Okay, let's say in 2019 you are investing in this company and they give 0. It means they stop because they can't give. So you can't ask the company and you oblige it to give you a dividend, because it is not something that that it is obligatory. The company gives a dividend is to make it attractive, to make the stock attractive to investors. Okay, so the first criteria is look for the increase of dividend. 0.25 in the quarter, let's say 0.35, let's say 2019, they give, let's say, $1. This is a big jump. Now, if the company gives $1, it means that the company is doing better and better and better. So, dividend increase is one of the best criteria you can see. But I'm telling you something very, very important. The price of the stock should increase also. This is the trick. So I will repeat again. Let's say the stock here was $25. Now, next year, it should be more than $25. Let's say the stock is $27 and they give 0.35. It means that the stock appreciation is going up and the quarter is going up, the increase. So it's not when the stock is $25 and 2018 they give 0.35 when the stock is 15, for example. So here they might give more because there is a problem in the company, and they give more. It is just to attract these people and to tell them, okay, I'm giving you more dividend, so hold for the stock or hold for the company. So this is just a technique that some companies do. But for us, when we are searching for these companies, okay, so we should have a price increase also. Okay, let's say it is $27. So this is the first. So this is the first criteria, and hope you have understood this. If you have any questions, please, whenever I explain criteria, please note it and ask questions if you have questions. Now, let's say right now we go to the second criteria. Okay, to the second criteria, which is second criteria is profits increase. Now, what does it mean? It means that the company is making more money each year. For example, let's say this is a company that made $1 billion, okay, on this quarter of 2017. Let's say this quarter 2018, okay, the company has made $1.2 billion in this quarter. Now, it means there is a 20% increase in the profits. It means that this company is growing better and better and better. Okay? So, understand that we value companies because they are making more and more and more money. When they make more and more money, the company becomes bigger and bigger and bigger. That's why you see in the market there are very tiny companies like penny stocks, and you find small companies that you find them in Russell 2000. Then you find the medium companies like S&P 500, and then you find the biggest companies in USA, which is the Dow Jones 30 stocks. Okay? So understand this idea of money. The company should increase money each year in profits. This is one of the best things you should look. And it's very easy to look. So you should do your homework. You go to any company, Yahoo or Google or any other website, and it will show you year by year what is this company is making. Is it making more or making less? Okay? Now let's go to number three. Number three, which is something more important. Okay, and number three is ahead over competition. Now you ask the question, now what does it mean, this ahead over competition? I will give you an example. Okay, Apple, for example. Okay, if you take, for example, the smartphone, there are other companies, small companies, other companies that are making smartphones and other phones. But Apple, okay, is ahead over competition for almost all, except there is one which is big company, which is from South Korea, and all of you know it. It is Samsung. Now, Samsung is a real competitor for Apple, but Apple is ahead over competition in terms of all other companies here and there that they are making smartphones. Because when you take Apple or you take Samsung, you will find that we have a lot of criteria, a lot of features that are good in smartphones. So your company that you want to invest in, it should be good competing the other companies. Now, if you choose a weak company, let's say a company that it is making a smartphone, but it is not selling that much, and the people, they don't like the way the smartphones are, so they are not selling. So these companies will not make that much money. And by the time, sometimes this company collapse and stop. So that's why you try to put all your money into a company, and then this technology of this company is, as I said, is weak. It's not as superior as Apple or Samsung. Okay? So because Apple and Samsung, they have similar features, and they are doing their best to have the whole market. Because understand, in some markets, okay, in some markets, as I explained here, let's say this is the whole market. Let's say Apple has this, and Samsung has this, and the other companies has this, other parts like this. So if Apple is here and Samsung is here, it means they have the whole, almost the whole money. Because when we say the market, we mean money. It means customers who are buying. We mean by customers who are buying the cell phones, for example, or the smartphones. And this is the profits for Apple and Samsung. That's why they are making more money. That's why they are having all the market for them. The small companies, they can disappear at any moment because of technology, or because the people, they don't like them. Okay? Or small minority of people, they buy this because they are cheap. Okay? And all the people, they like expensive smartphones because they give more features that the people like. Okay? So, with this one, understand that each year in America, we have bankruptcies. Do you understand what does it mean, bankruptcies? Bankruptcies, it means the company cannot make that much money to stay in the market. They don't make money. Or they make less or little. They can't pay their employees or their associates or their workers. They can't. Or the thing they sell is not appreciated anymore. Okay? And understand that there are, for example, in this smartphone companies, there are a lot of companies that they are not smart. They don't produce smartphones. They collapse and they go bankrupt. So understand that. So competition, it means the company that you are going to buy, it should be robust, big and strong, and what it makes is appreciated by the people. Okay? Now, let's go to number 4 right now, since we have 8. So, number 4 is something general. Okay? Now, when you choose a company, you should look at its capitalization. Now, what does it mean, capitalization? Now, understand that we have Dow Jones, 30 biggest stocks. Okay? These are big capitalization. It means, what does it mean, big capitalization? It means if you multiply the common shares outstanding by the price, this is called capitalization. You find that these companies, 30 companies, they are the biggest. And almost, you say, for example, $200 billion, $150 billion. It means those companies are big. They are so big. Okay? Now, the second capitalization, you find S&P 500. It means that these companies are medium. Medium, it doesn't mean they are just little. No, they are big, but they are not as big as the 30 stocks. You can find, for example, 12 billion, maybe 100 billion. So I don't know the exact price to change from S&P 500 to be like biggest Dow Jones. So I don't have the exact price they choose. But medium, it is companies that are big, but they are not so big as the Dow Jones stocks. Okay? Now, the third, we have what you call Russell 2000. There are 2,000 companies that are called small. Now, small, it doesn't mean they are penny stocks. Penny stocks are smallest. Penny stocks are smallest. But these have some kind of capitalization and they are growing good. That's why they are in 2,000 small companies. Now, for you, when you are going to invest, it's up to you. Either you can go to Russell 2000, S&P 500, or Dow Jones. If you are not aware where these companies are or your company is, just Google it. Google S&P 500 stocks, and you will find websites that they give you the whole 500 companies that consist of S&P 500. Understand that these stocks can change because it depends on the capitalization. if this capitalization go down, they can take this stock from here, put it here. And then a stock from Russell, they can put it here because it becomes medium. So if you want Russell 2000 stocks, you can just Google it. You find the 2000 stocks, and then you can choose the stock that you are looking for. Now, if you are looking for the 30 stocks, they are there in the Dow Jones. I always show them. They are very simple to find. Just look at them and see which one you want to invest in. Okay? Now, this is called capitalization. So understand that it depends on you. It doesn't depend on someone else to tell you which company you are going to invest in. Try to take your own decisions. Don't look at anyone. You have the criteria. You have read some books criteria. You have seen online criteria. So you should make up your mind and find your companies that you want to invest in. No one will tell you if they are good or bad, because it's only the future. After 2 years, 5 years, 10 years, you will see. Maybe you have a 2000 Russell 2000 stocks. You grab one of them, and this one becomes a very, very big company in 5 years and 10 years. Who knows? But you should look all the criteria that I have said in order not to be mistaken. So let's go right now and try to find what are the criteria number 5. Okay, let's see, we change the color. So number 5 is price appreciation through years. Most of you guys understand what does it mean, this price appreciation through years. It means, if we take an example of Facebook, for example, it was 1755 in 2012. Now 2018, let me see the price now of Friday. Just give me 1 minute. Okay, it's 193.99. Okay, now what is this thing that you are seeing? Is that price appreciation? It means the stock is going up. Okay, through years, 2000, for example, 12, 13, 14, 15, 16, 17, 18, let's me here. Okay, the stock is growing up through years. Now here, if there is, for example, let's say there is a correction, like when we see the correction, you see, for example, the correction here, the stock is going down. This is something that it is general to the whole market. It's not only Facebook that goes down, but it is everything. So this is the correction. Now the stock is going, now the stock is going up. Okay, it's going up. So try not to count this correction, because correction, it happens to the whole market. Almost all the stocks, they go down. But in general, this company is having what we call price appreciation. Now you can take any other company that it is growing up. But I give you another example that I showed in our some videos. The General Electric, it was 33 last year. Now it is 15, for example. Now, this company has lost 50% from last year. Now, for me, I'm not going to buy or to invest in this stock because I see something bad happening to this company. And 15, you will never know. Maybe you invest in it and it will go down. It lost 50%. It can lose 70%, 80%. You have seen, for example, Sears. What did happen to Sears? It's go down. Okay? So understand that companies who have difficulties, this price, there is no price appreciation. The stock is going down. So understand that when the price is going down for a long time, 6 months, 1 year, 2 years, 3 years, understand that this is not an opportunity to buy. For me, it is not an opportunity to buy. It is an opportunity not to buy. Because for me, I want the stock to go up. I see this price appreciation in order to invest in the company. I don't want to invest in a loser. I want to invest in a winner that has some facts in the market. It's going up. It's doing good. It's making more money. It becomes bigger and bigger. Why should I go to a company that is losing money, the stock is going down, and all the people say bad about it because of the earnings, of management, competition, a lot of stuff? Okay, so this is just one of the things that I am trying to explain. So just you get an idea about how I choose my stocks. Now, let's go to another, number 6, which is called stability through time. Stability through time, what does it mean? It means the company, I give you an example about a company, just how it moves. Let's say the stock was $20, it moves to $40, and then it goes down to 20 here, and then it continues to go down, and now it's $5. Now, if you are investing in this company, you see that there is no stability here, because it goes 1 year or 2 years or 3 years good, but now 1 year or 2 it lost all these profits. Think about you that you bought it here. This company, you bought it at 20. It goes to 40. Let's say in 2 years you are doing so good and your company is doing good, it's making money. But there is no stability, because after 40 it goes to $20 in 1 year. When it goes down to it lost 50%, 50% lost from this $40, it becomes $20 again, and then it continues to go down to 5. Understand that this company has trouble. When the company has trouble, the big investors here, who are mutual funds, what they do, from 40 they begin to understand that this company has shown some problems. Now, these mutual funds, they will not decide in one day or two to sell everything. No. When they understand that there is a problem in this company, what they do, they begin to sell, and the stock is going down to sell and each mutual fund sell all its shares. This mutual fund goes and buy another company. Other people who are staying here, a lot of people, they begin to sell until it becomes $5. Now, if you are waiting until $5 and this, it means there is no stability and you are just wasting your time because you lost your profit and then you lost all your profit and then you begin to lose your money. So the time here, staying in the time is not good for you because the direction of the stock is the opposite. There is a reverse. Okay? So this, it is just to understand that stability of a company, it means what is the thing they do. Okay? Are they making this company? When you look at this company, if you dig into it, you will find problems. This company, maybe it is selling something that it is not appreciated by the people, low technology, or a product that no one wants, or the habits of the people change and they don't need that product anymore. So this company begin to lose money. They want to sell but no one buys, or few people buys. So they begin to lose money. Now, we are lucky that in the stock market, the company each 3 months, it files the statement. So you should go and see if there is any change. Don't just you invest for 10 years and you don't see what your company is doing. So stability is something very, very important. Okay? So let's go to some other criteria, which is 7. So we are in 7, and we will finish to number 8 and then we stop. So another thing that you should see is international growth. Now, why I say international growth? It means, let's give you Walmart as an example. Okay? Walmart was in USA, but now you will find it in almost all countries of the world. Not in all of them, but in most of them. Now, why, in your opinion, if I ask you the question, why Walmart as a store has succeeded to go to other countries while other companies here that are in retail, they go bankrupt? Okay? See the opposite. Why some companies, they go bankrupt here in the USA, and other companies, they succeed here in USA, and they go overseas in other companies to conquer other countries' markets. Now, the more you go, if you succeed in other markets for the company, this becomes an international growth. What does it mean? More money coming to you from other countries. And you are doing the same thing as you do in USA. Okay? So this is why some companies, they can become bigger and bigger through the time. And they succeed to go out of USA, it means what we call overseas, and they are making more money. So when you invest in your company, ask yourself, can this company go to become international? Yes, yes, or no. Okay? This just, it's not an obligation, but it is something that shows. For example, when you say Walmart, I can say Apple also, and there are other companies that in USA that they go overseas. Now when they go overseas, they are selling and they are making more profits that comes to USA. That's why these companies becomes bigger and bigger and bigger. Okay? So don't forget this idea of international, because international, what does it mean? It means just it is a success. It means it controls USA and it's making a lot of money, but they don't stop into USA. They want to see other markets and making more money, because other companies or other countries in the world, they need your expertise, they need your stores, and that's why they make money. Okay? And this is something very, very important for those who wants international growth and their companies is everywhere in the world. Even there is something funny. Okay? Look, for example, at Facebook. It connects 8 billion person in the world. Understand that. That someone in the jungle, okay, he doesn't find what to eat, but he has a smartphone to see his friends in the jungle also. Okay, so this is funny, but you know, it's this growth that I'm speaking about, that all the people are using your products. Okay, Apple everywhere in the world. I give you another thing that it is some people they don't think about. Coca-Cola, for example. I'm telling you that you go to Amazonia jungle or Africa and you find people drinking Coca-Cola. Maybe they don't have fruit or vegetable to eat, but you find that they are buying Coca-Cola. You see how this company succeed. What's this Coca-Cola that everybody in the world, they want to drink it? There are hundreds and thousands of similar Coca-Cola, but why Coca-Cola and Pepsi-Cola, they go international and all the people, they want to drink it? This is the phenomena that I'm speaking about always, and about success. Okay? The people, they continue to buy Coca-Cola. Okay? It's just because of the brand name, because the people, they like it, and because it's something that people like. Now, so since we have seen 7 criteria, right now we are going to the last criteria. Okay? To the last criteria, which is people best review. Understand that in some products, okay, in some products, the people, they use this product and then they buy and they love it, and then they have good review. Now, if I, for example, I want to compare between smartphones, Apple and Samsung, for example. So I don't know what's the difference and what are the features. So I go online on YouTube or in any other means like Google, and I try to see reviews. Now, if you find a lot of reviews about Apple, probably you are going to use Apple smartphone because you have seen a lot of reviews, and then when you buy it, you love it because of this, and then you talk to your friends. It means you advertise for free. This is free advertisement. Companies, they are spending billions of dollars to advertise, and a lot of companies, they go and they get this for free. Okay? They get it for free because of the good best reviews. And if you are going to, for example, to a restaurant in the city, you can see reviews and you can see restaurants, and you can choose this one and you don't like this one, even though you don't go to it. But if you see bad reviews, probably you are not going to it because of these bad reviews, because you get scared. And you don't like it. Okay? So these people best review is something very, very important about the company and what it does. And I'm telling you that people's best review, you can review the company by yourself. Okay? It means if you use its own, for example, you use its own products, you can make a review, and you have your own opinion about a product. Okay? And then if you like this product, probably you go and you buy this company stock because of this product or because of this service. This is what we mean by best review. It could be yours, it could be other people, but when you see a lot, you will have an opinion about this stock, and then you can buy it. Okay? So these are the 8 things that I want to share with you. I understand people, they ask you to go to the balance sheet. You have hundreds of items, a lot of things to read, a lot of things to focus on, but most of the time all this stuff is for professional people. They are not for public. The public, like me and like you and others, you just see the best in the market and you just invest in it. Okay? It's not that hard. If you succeed in 1 or 2 stocks, that's it. You don't need to buy 100 companies in order to be rich. You can buy 4 or 5 or 6 companies that you like, that you see growing, they are doing good, and that's it. You put all your money there, and that's it. I know there are other criteria that we have spoken before, like diversification, like the other stuff, but this is understood. Okay? Why, for example, you go, there is Apple and Samsung, and you buy Apple and Samsung? Why you do that? They are competitors, and it's not that good to buy the same industry. You buy 2 companies or 3. What if this industries or this sector has a major problem, like the energy sector before? Energy sector suffered before from this trouble, and all the sector is going down, and they lose a lot of money. So you should not do the same mistake. This is obvious because everybody, everywhere, the people are talking about it. And I have talked about investing in other criteria that are less important. Okay? But for me, these, what I show you, are something that it is obvious. You see them, but the people, they don't talk about them because either they choose one or two or three, or because some people, they don't know about them at all. When I speak, for example, about competition, a lot of people, they don't give it importance, but understand that your company, if it's not doing good in the competition, it can be left behind and no one will buy its products, and it will disappear from the market by bankruptcies. In USA, each year we have hundreds of companies that they go bankrupt, but there are other hundreds or thousands of companies they start. So you see, it depends on the ideas, it depends on how you manage what is your model of business. It is a lot of things. So thank you very much for watching. I know it's a little bit long, but if you have watched the whole video, please, if you have other criteria that you think it's very important, please put them into comment and I will comment back. Thank you very much and have a nice day.